This is our foundation. We begin by establishing the safe space where financial realities are discussed without noise. When emergency sessions materialize within hours of political upheaval, we witness the true mechanics of market confidence unraveling in real time. The infrastructure upon which modern finance operates rests on a singular, fragile premise: collective belief. Institutions, credit systems, and asset valuations exist not because of intrinsic backing, but because participants maintain synchronized faith in their continuation. Warren Buffett's measured response to institutional turbulence reveals what seasoned capital stewards understand. Volatility exposes the leverage lurking beneath seemingly stable equilibria. Political shocks trigger cascade effects through interconnected financial networks. Margin calls accelerate. Liquidity dries instantaneously, and counterparty risk suddenly dominates decision-making. The market's architecture, engineered on assumptions of orderly function, cannot absorb simultaneous distrust across multiple systemic nodes. Understanding this dynamic is essential. Confidence operates as collateral itself. When political uncertainty compounds regulatory concerns, that collateral evaporates. Our analysis moves beyond headlines into the mechanics of contagion, examining how emergency interventions attempt and frequently fail to restore faith in fundamentally stressed systems. The market has been placid for months. This emergency disrupts that narrative and forces us to ask uncomfortable questions about the very foundation upon which modern finance rests. What we are witnessing is not merely political theater, it is a stress test of institutional credibility itself. When Warren Buffett, the custodian of rational capital deployment, issues guidance amid sudden constitutional upheaval, markets must reckon with a fundamental truth. Stability was never structural. It was psychological. The paradox emerges starkly here. Confidence in our financial systems depends entirely on the assumption that governance mechanisms function without rupture. Yet, the moment those mechanisms face unexpected strain, the entire edifice of trust, which cannot be audited, collateralized, or quantified, begins to fracture. This is not volatility. This is revelation. Passive liquidity evaporates when conviction collapses. Asset prices, constructed atop layers of leveraged assumptions and derivative chains, suddenly confront the reality that their floor was always subjective. The emergency session forces investors to acknowledge what they've obscured. That systemic stability rests not on regulatory frameworks, but on collective faith that remains perpetually one shock away from disintegration. Because political uncertainty directly influences capital allocation decisions, and Buffett's commentary is a canary in the institutional coal mine. We must recognize that this moment transcends partisan rhetoric. It represents a cascading failure in confidence systems themselves. When institutional titans break silence during political convulsions, markets internalize a buried signal. The foundation of predictability has fractured. Buffett's measured intervention signals that legacy capital perceives asymmetric risk beyond conventional quantification. Political removal mechanisms trigger immediate repricing across fixed income instruments. Equity volatility indices spike, and foreign capital exhibits flight behaviors consistent with confidence erosion. The urgency stems not from the political theater itself, but from the liquidity implications embedded within. Once, institutional anchors question continuity. Retail investors follow a phenomenon economists term reflexive cascade. Asset prices reallocate instantaneously as unhedged exposures become visible liabilities. This moment matters because it exposes the phantom stability we've constructed. Markets function flawlessly only while trust remains unquestioned. The second that assumption cracks, the entire architecture of leverage, derivatives, and interconnected obligations becomes transparent in its fragility. We are witnessing the mechanical vulnerability of confidence-based systems in real time. Block for thesis. Now, we pivot to the mechanics, understanding how political legitimacy functions as invisible collateral in the financial system. The market does not operate on earnings alone. It operates on the perpetual expectation that institutional guardrails remain intact. When a chief executive faces removal, markets are not merely pricing in policy uncertainty. They are repricing the entire faith structure upon which trillions in asset valuations rest. Confidence in this framework becomes collateral. It is the unwritten guarantee backing sovereign debt, corporate bonds, and equity indices alike. When political legitimacy fractures, that collateral depreciates instantly. Warren Buffett's cautious positioning reflects this understanding. A seasoned capitalist recognizes that leverage, both financial and institutional, corrodes rapidly when trust erodes. The emergency session signals a watershed moment where the invisible becomes visible. Investors must grasp this truth. Markets crash not when fundamentals deteriorate, but when the foundational assumption of institutional continuity collapses. This is systemic fragility operating at the highest order, with our thesis established. We now deconstruct the technical architecture that holds everything upright. The three pillars of market stability: liquidity, confidence, and regulatory oversight form an interdependent triad, where the failure of any single component cascades through the entire system. Liquidity, the first pillar, functions as the circulatory system of capital markets. When it dries up, even solvent institutions face existential pressure. Confidence, the second pillar, is fundamentally psychological, a fragile consensus that assets retain value. This pillar collapses instantaneously when narratives shift, regardless of underlying fundamentals. Regulatory oversight, the third pillar, attempts to enforce rules that prevent excessive risk-taking. Yet, regulatory capture and lagging policy response create dangerous temporal gaps. When political upheaval such as emergency sessions or leadership transitions introduces uncertainty into this architecture, institutional actors begin hedging simultaneously. Massive capital flows toward safe havens accelerate, credit spreads widen, and funding markets freeze. The mechanism is insidious. Each pillar weakens the others under stress. Buffett's measured response signals what sophisticated investors already understand. Systemic fragility isn't dramatic, it's structural. The mathematical certainty of contagion remains buried beneath surface-level market indices. Block 6. Executive authority. As economic collateral, the President's office controls Treasury authority, fiscal policy direction, and regulatory enforcement. Removing it creates a vacuum in economic governance that reverberates through every asset class simultaneously. This is not merely a political disruption. It is a structural collapse of the confidence mechanism upon which trillions in financial instruments rest. When executive authority fractures, the implicit backing of government credibility, the ultimate collateral securing sovereign debt, currency stability, and regulatory predictability evaporates instantaneously. Markets, contrary to popular belief, do not price uncertainty smoothly. They price contagion risk exponentially once the system's foundation shows cracks. The Treasury yield curve flattens, liquidity dries up, and counterparty risk spreads like systemic infection through the banking network. Warren Buffett's measured response underscores what institutional investors already comprehend. Executive instability is an undiversifiable risk. You cannot hedge the currency itself, nor can you escape the jurisdiction of the state whose executive is compromised. This mechanism where governance authority becomes the ultimate collateral, backing all downstream financial claims, exposes the fragile dependency of modern capitalism upon institutional continuity. Understand this. Liquidity evaporates fastest when participants cannot price political risk accurately. When an emergency session convenes, with removal proceedings initiated, market participants face an unprecedented valuation problem. They cannot deploy conventional models because the variable has become non-standard. Institutional investors, margin-dependent traders, and algorithmic systems simultaneously retreat from risk exposure, creating a liquidity cascade that operates like a mechanical law rather than a market choice. The mechanism is ruthless. As bid-ask spreads widen, forced sellers accelerate exits, triggering further repricing downward. Warren Buffett's measured response signals something deeper than reassurance. It acknowledges that confidence itself has become the underlying asset under scrutiny. When the cornerstone of price discovery becomes political uncertainty rather than fundamental valuation, markets don't gradually adjust, they seize. Leverage positions unwind violently. Counterparty risk resurfaces. What began as policy shock transforms into systemic vulnerability. This is not volatility. This is the architecture of financial fragility exposed. The system depends entirely on belief that tomorrow's rules resemble today's framework. That dependency, once questioned, collapses swiftly. Buffett maintains $157 billion in cash, ostensibly dry powder for opportunities, but mechanically, it's political insurance. This distinction is critical to understanding how institutional capital functions during systemic volatility. When confidence erodes, liquidity becomes the ultimate hedge against cascade failures. Buffett's fortress balance sheet operates as a stabilizing counterweight to market dysfunction. His willingness to deploy capital signals market solvency to other institutions. However, this mechanism harbors a latent risk. The market has become psychologically dependent on megacap institutional intervention to validate asset valuations. Should Buffett's cash remain dormant, or worse, should deployment signals reverse, the market loses its institutional floor. The real danger isn't what Buffett does, but what his inaction communicates. In fragmented trust environments, silence from authority figures accelerates panic transmission. His response cadence now functions as a macro indicator itself, pricing in not merely financial conditions, but political uncertainty. This transforms the world's most conservative investor into an unwitting systemic relay, where his balance sheet mechanics telegraph institutional confidence levels to millions of subordinate actors searching for signals. Beneath equity surfaces live trillions in derivative contracts, whose enforceability depends entirely on judicial continuity. When political uncertainty destabilizes executive authority, the invisible machinery of counterparty risk begins its lethal recalibration. Credit default swaps, interest rate hedges, and equity derivatives instruments notionally valued at over $600 trillion globally suddenly face pricing dislocations. The moment institutional confidence erodes, each counterparty reassesses whether its trading partners can honor obligations in a fragmented legal landscape. Banks holding $200 trillion in off-balance sheet derivatives discover their hedges are only as robust as the judicial systems backing them. Warren Buffett's cautious response reflects this reality. Liquidity evaporates when counterparties simultaneously demand collateral. Margin calls cascade, and forced liquidations ignite contagion. The derivative market isn't merely interconnected, it's parasitic on governmental stability. Constitutional upheaval doesn't just move equity prices. It weaponizes leverage throughout the financial system, transforming paper profits into liquidation nightmares for unprepared institutions. Treasury yield expansion. The contagion begins. The real economic damage begins in the bond market, where political uncertainty translates into required yield premiums. When institutional investors, pension funds, insurance companies Foreign sovereigns perceive regime instability. They demand higher returns to compensate for amplified refinancing risk. This is not speculation. It is the mathematics of capital preservation. A 50 basis point spike in Treasury yields forces mark-to-market losses across massive fixed-income portfolios, instantly eroding the collateral base that anchors the entire financial system. Banks holding long-duration securities face immediate liability mismatches. Corporate debt servicing costs accelerate. The mechanics are relentless. Rising rates compress bond valuations, triggering forced selling, which accelerates yields further, creating a negative feedback loop. This contagion spreads through derivatives, repo markets, and cross-asset hedging relationships. Buffett's measured response advocating stability reflects a deeper truth. Confidence, once fractured, cannot be easily restored through rhetoric alone. The bond market remains the ultimate arbiter of systemic health, where political theater meets economic reality. Retail investors see headlines. Institutional portfolios see margin requirements exploding. This distinction illuminates the chasm between perception and financial reality. When political uncertainty triggers volatility spikes, the mechanical system beneath pristine trading screens reveals its fragility. Large investment firms carry borrowed capital leverage that amplifies gains during calm markets but transforms into a guillotine during liquidation events. A seemingly modest 15% portfolio decline can trigger cascading margin calls, forcing institutions to dump assets indiscriminately, regardless of intrinsic value. This forced selling becomes contagion. Price capitulation accelerates. Collateral values deteriorate, and suddenly solvent institutions face insolvency thresholds. Warren Buffett's cautious posturing reflects this reality. He recognizes that systemic confidence rests on a foundation of borrowed money and interconnected counterparty risk. The emergency political session operates as mere headline noise to retail participants, yet triggers algorithmic rebalancing among hedge funds carrying 8-to-1 leverage ratios. The market's architecture demands faith in perpetual liquidity. Political shock exposes the lie. When margin calls arrive, no headline explains it away. Political uncertainty directly weakens the dollar because foreign central banks reassess reserve currency assumptions. When political stability fractures as emergency sessions and removal procedures signal international holders of U.S. Treasury bonds and dollar reserves recalibrate their risk models instantaneously. This isn't dramatic or visible on evening news. It's a silent hemorrhage occurring in the algorithmic depths of global financial systems. Foreign central banks, particularly those in Asia and Europe, begin diversifying away from dollar holdings, a process accelerated when institutional confidence erodes. The mechanism operates through currency devaluation, a quiet theft disguised as market adjustment. As demand for dollars declines, purchasing power evaporates for American consumers and savers holding cash. Your savings lose real value not through explicit taxation, but through the inflation that follows reduced currency demand. Warren Buffett understands this dynamic intimately. He accumulates tangible assets precisely because he recognizes how political instability triggers currency debasement. The Treasury cannot publicly acknowledge this mechanism without triggering panic. Instead, policymakers manage narratives while the devaluation proceeds silently, transferring wealth from dollar holders to those owning productive assets and hard commodities. Equity valuations rest on profit forecasts that assume policy continuity. Emergency removal sessions invalidate those assumptions instantly. The entire architecture of modern market pricing collapses the moment political uncertainty enters the equation, not gradually, but with the abruptness of a circuit breaker halt. Consider the mechanics. Analysts project earnings under current regulatory frameworks, tax structures, and trade agreements. These projections form the foundation of discounted cash flow models that justify today's valuations. When an emergency session signals potential executive removal, those assumptions become speculative fiction. Corporate guidance evaporates. Supply chains face re-evaluation. Capital expenditure plans freeze, pending policy clarity. The cascade ripples through leverage ratios and debt covenants tied to earnings thresholds. Buffett's measured response signals institutional awareness of this fragility, not panic, but recognition that the confidence system underlying equity markets rests on foundations less solid than publicly acknowledged. When profit assumptions dissolve, so does the mathematical justification for current stock prices. The market doesn't price in complexity. It prices in certainty. Remove that certainty, and systemic repricing becomes inevitable. Now, we shift from technical mechanics to the psychological architecture that transforms mechanism into catastrophe. The confidence cascade operates as an invisible circuit breaker within institutional finance. Once the first major player signals distress, whether through margin calls, credit downgrades, or public uncertainty, the system enters a phase of accelerated information asymmetry. Large investors tussen fund managers and depolge of system. They cannot distinguish between localized stress and systemic contagion. This uncertainty breeds preemptive action. The rational individual response: withdrawing capital, liquidating positions. Seeking safety becomes collectively catastrophic when executed simultaneously across thousands of institutions. Buffett's measured response to current political instability reflects this calculus. Leadership credibility directly translates to capital confidence. When regulatory authority appears compromised or succession becomes contested, institutional actors face genuine uncertainty about deposit safety, contract enforcement, and counterparty reliability. The panic architecture requires no actual insolvency to trigger cascade failure, only sufficient doubt about whether the system's guarantees remain credible. Retail investors now comprise 40% plus of market volume. They've become systemic to the system itself. This represents a fundamental inversion of market dynamics that few institutional actors fully comprehend. When retail cohorts move in synchronized patterns, driven by sentiment rather than fundamental analysis, they create cascading liquidity events that destabilize traditional price discovery mechanisms. The herding instinct, behavioral finance's most dangerous predator, operates through social proof and information asymmetry. A single catalyst, amplified across retail networks, triggers simultaneous buy or sell orders that overwhelm market makers' capacity to absorb volatility. What appears as democratic market participation masks a latent fragility. When confidence evaporates, these same retail flows reverse with devastating velocity. The 2008 crisis taught us that interconnected leverage creates systemic risk. Today's retail concentration operates through behavioral contagion, equally corrosive, equally invisible until the moment of rupture. Portfolio managers now face an unsettling reality. The margin of safety has contracted precisely when systemic complexity has expanded. Understanding retail behavior is no longer peripheral analysis, it is fundamental risk assessment for navigating contemporary capital markets. International implications compound domestic crisis within hours. When political certainty collapses at the center of global financial order, allied nations immediately recalibrate their risk assessments. Japan, South Korea, and European treasuries are now pricing an unprecedented scenario: accelerated deleveraging of dollar-denominated assets and potential capital flight from U.S. markets. This isn't speculation, it's institutional survival mathematics. The yen's sudden strength, despite Bank of Japan interventions, signals capital repatriation. European central banks face immediate liquidity pressure as swap lines tighten. Geopolitical realignment manifests first through currency markets, then cascades into equity volatility. When institutional confidence in American political stability erodes, the traditional safe haven status of U.S. Treasury bonds weakens. Allies, dependent on dollar hegemony, must now calculate exit costs against holding costs. The arithmetic is brutal. Every hour of political ambiguity translates into basis points of yield, compression, and widening credit spreads. This interconnection between domestic political fragmentation and international capital flows reveals the true fragility of confidence-based systems. They collapse not through gradual erosion, but through sudden revaluation events. Regional and mid-sized banks face deposit flight when political uncertainty peaks, a phenomenon that exposes the precarious architecture underlying modern banking systems. When confidence erodes, whether triggered by executive turmoil or macroeconomic shock, depositors flee to perceived safety, creating liquidity crises that cascade through interconnected financial networks. The shadow banking sector, which operates outside regulatory guardrails, amplifies this contagion. These non-traditional lenders and investment vehicles, lacking deposit insurance protections, become conduits for systemic risk when mainstream banks contract lending. The leverage embedded within shadow banking magnifies losses during stress events. What appears as diversification becomes interconnectedness. What seems like competition becomes systemic vulnerability. Warren Buffett's measured response to current political turmoil reflects awareness that institutional fragility precedes visible collapse. The confidence-based foundation of banking, fundamentally a collective agreement to trust, cannot withstand sustained political dysfunction. Regional banks, holding mark-to-market losses and compressed net interest margins, face particular vulnerability. Their survival hinges not on fundamentals but on continuous depositor belief. This distinction between solvency and confidence defines modern banking's existential paradox. CRE borrowers face immediate refinancing challenges when political risk spikes rates. And this structural vulnerability reveals the systemic fragility embedded within our credit infrastructure. Commercial real estate represents not merely a sector, but rather a critical node in the broader financial network, one where leverage, maturity mismatches, and confidence-dependent valuations converge with potentially catastrophic force. When political uncertainty triggers rate volatility, the mathematics of debt servicing deteriorates rapidly. Properties financed during low-rate periods suddenly require substantially higher capital allocation to refinance maturing obligations. This cascading pressure extends beyond individual borrowers into the broader banking ecosystem, where CRE loan portfolios constitute material portions of regional and mid-sized lender balance sheets. The contagion mechanism operates insidiously. Stressed borrowers default, prompting asset sales at depressed valuations, which simultaneously compress comparable property values across portfolios. Asset-backed securities tied to CRE collateral experience mark-to-market losses, eroding capital buffers and forcing institutions toward fire sales. What appears as isolated borrower distress inevitably metastasizes into systemic liquidity seizure, demonstrating how confidence-dependent systems collapse not gradually, but through cascading validation failures. The political trigger merely accelerates an existing structural condition. Pension funds face a mathematical crisis when political uncertainty spikes required return assumptions. This actuarial avalanche represents one of the most insidious threats to systemic stability, operating beneath public consciousness while eroding foundational retirement security. When markets convulse as they inevitably do during political shocks, pension managers confront an immediate accounting reality. Their assumed discount rates become untenable. The liability side of the balance sheet explodes. Suddenly, The gap between promised obligations and available assets widens catastrophically, forcing institutions to divest holdings precisely when liquidity evaporates. This forced selling cascades through equity markets, compressing valuations further and triggering additional margin calls across interconnected portfolios. The mechanism is merciless political risk healer vlor the prices. Funding ratios collapse, forced rebalancing market contagion. Warren Buffett's cautious posturing reflects awareness of this mathematical time bomb. Pension funds manage trillions in capital globally. When they retreat simultaneously, no circuit breaker exists to absorb the vacuum. The system's fragility crystallizes in these moments confidence-dependent structures. Collapse fastest when confidence itself becomes the variable that moves. This is not speculation. It is actuarial mathematics made visible through institutional panic. Block 20, the insurance sector repricing, tail risk awakening. Insurance carriers and reinsurers price in catastrophic loss scenarios when political stability is questioned. This mechanism operates beneath the surface of public consciousness, yet its implications ripple across entire portfolios. When systemic uncertainty escalates, as we observe in moments of institutional turbulence, actuaries recalibrate their models instantaneously. Claims reserves inflate. Capital adequacy ratios tighten. Premiums surge, not from sudden natural disasters, but from mathematical recalibration of probability distributions. The insurance sector functions as the hidden nerve center detecting systemic fragility. Underwriters read political risk like seismographs, detect tremors. Shareholders accustomed to stable underwriting spreads face margin compression. Bond investors confront duration extension as insurers lock in longer liabilities. Pension funds holding insurance equities experience unexpected volatility. This repricing phenomenon exposes a harsh reality. Our financial architecture depends entirely upon collective confidence in tomorrow's predictability. When that confidence fractures, even institutions explicitly designed to absorb risk become conduits for contagion, transmitting losses instantaneously through interconnected balance sheets and derivative exposures across global markets. Before we discuss defense, we must calibrate expectations. Understanding what realistic scenarios look like requires stripping away the theatrical noise and confronting the mechanics of systemic fragility. When institutional confidence fractures at the executive level, the transmission mechanisms are brutally efficient. Capital reallocation accelerates, liquidity premiums compress, and counterparty risk suddenly becomes quantifiable rather than theoretical. The markets don't punish political uncertainty abstractly. They price the cascade of cascades. Derivative exposures unwind. Margin calls ripple through leveraged positions. And the synthetic leverage embedded in modern finance becomes visible to everyone simultaneously. Warren Buffett's measured response isn't apathy. It's recognition that volatility creates asymmetric opportunities only if you possess dry powder and conviction when others face forced liquidation. This is the critical distinction. Probable impact isn't measured in headline severity, but in how many nodes of the confidence network simultaneously require recapitalization. When faith in institutional integrity destabilizes, the mathematics of contagion follows cold arithmetic, not sentiment. Your first defense is structural rebalancing before panic forces rebalancing on adverse prices. This is not theoretical prudence. It is the mechanics of capital preservation in a fragmented financial system. When political uncertainty collides with market volatility, the first casualty is orderly price discovery. Your portfolio's current allocation reflects yesterday's risk appetite, not tomorrow's volatility regime. Disciplined rebalancing serves two critical functions. It systematically locks in gains from overweight positions before sentiment reversal. And it establishes dry powder in defensive assets before forced selling cascades through the market. The difference between proactive and reactive rebalancing is often the margin between modest losses and catastrophic drawdowns. Investors who wait for clarity are already too late. Clarity arrives only asterisk after asterisk capitulation. By rebalancing systematically across predetermined bands, you sidestep the psychological trap that paralyzes institutional decision-making during systemic stress. This is not market timing. It is structural discipline. The institutions that survive volatility shocks are those whose architecture resists panic-driven decisions. Your portfolio's architecture must do the same. Your second defense is tactical building cash reserves that allow you to buy, not sell. When systemic stress emerges, forced liquidation becomes the instrument of destruction for the unprepared. Those holding 60 to 70% of their capital in a liquid or equity-heavy positions face an asymmetric catastrophe. Selling into collapsing markets at precisely the moment prices hit generational lows. The mechanics are ruthless. A 10% market correction cascades into margin calls for leveraged portfolios, triggering forced sales that deepen losses exponentially. Conversely, an investor maintaining a disciplined liquidity fortress substantial cash reserves, short-duration bonds, gold allocations transforms crisis into opportunity. This is not defensive pessimism. It is calculated optionality. When credit spreads widen and equity volatility spikes, dry powder becomes the ultimate asymmetric advantage. Buffett's fortress of cash, currently substantial, exemplifies this principle. Structural instability rewards those who sacrifice marginal gains during euphoria to preserve purchasing power when fear dominates. The distinction between wealth preservation and wealth destruction hinges entirely on this single variable, the ability to transact decisively when others hemorrhage capital. Build your fortress now. The walls matter immensely when the storm arrives. Understanding which signals matter separates disciplined investors from panic. Sellers, and this distinction becomes existentially crucial when political volatility threatens institutional stability. The 7 warning flags demanding immediate surveillance operate across interconnected systems. First, examine liquidity withdrawal patterns in asset classes traditionally considered safe havens. Second, monitor credit spread expansion, which signals deteriorating confidence in counterparty solvency. Third, track unusual insider trading activity and executive equity liquidation, as institutional insiders often possess foreknowledge of systemic fractures. Fourth, assess foreign central bank reserve composition shifts, particularly de-dollarization trends. Fifth, observe derivatives market dislocations and implied volatility clustering. Sixth, scrutinize banking sector deposit flight metrics and loan loss provision acceleration. Seventh, evaluate government bond yield curve inversions and duration risk premiums. These signals function as early warning instruments precisely because they reflect genuine economic actors, adjusting positions based on authentic risk reassessment rather than headline noise. When Warren Buffett pivots defensive positioning holding unprecedented cash levels, he articulates what technical analysis merely whispers. Confidence architectures are being stress-tested. Separating signal from noise requires disciplined observation of these 7 parameters. They reveal whether markets are repricing genuine risk or experiencing temporary sentiment swings. We close with the question that transforms information into wisdom and the commitment that transforms awareness into survival. What separates the solvent from the insolvent when confidence evaporates overnight? This is not academic speculation. The interconnectedness of modern finance means that political turbulence, executive turnover, or regulatory shock, regardless of their origin, propagate through credit markets with algorithmic precision. When institutional investors simultaneously reassess risk, liquidity dries up catastrophically. Warren Buffett's measured response reflects his historical understanding. Systemic fragility emerges not from obvious failure, but from cascading reallocations of trust. Your portfolio's resilience depends not on market timing, but on structural vigilance. Monitor correlation breakdowns between asset classes, track credit spreads widening, observe insider selling acceleration. These are the canaries. The reflexive question demands an answer. Are you positioned for disruption or merely positioned for continuation? Vigilance is not paranoia, it is the mathematical acknowledgement that confidence, once fractured, reconstructs far more painfully than it breaks.